But in terms of contact tracing, these sort of long-term efforts to isolate and support people that contract the virus, that's something that's quite difficult to do on a population level, and much more difficult when you have large and growing levels of community spread, as seem to be happening in states like Florida, Texas, Arizona. It's hard to trace contacts when there are lots of contacts.
Max, you're one of the 5 or 6 best people in the country on this. You've got a fabulous holistic view, coast to coast, and frankly, around the world. America doesn't want to trace, do they? I mean, this is hugely cultural. I looked at a chart yesterday, and I can't remember the details, folks, of the relative excellence of America in this pandemic versus other organized rich nations. Come on, Max, we're in last place. We don't want to affect these sensible rules, do we?
That does seem to be the case to some extent, and a lot of that I think has to do with the fact that there has been something of a national leadership vacuum on the issue. It's really been up to states to define the response, to sort of push these efforts, to push the notion that containing this virus, to lessening its impact over the long run, is going to take an individual shift of perspective, and put a lot of responsibility on every person in America. But your point about how we're performing relative to other wealthy nations is very true. If you look at a comparative chart of daily case incidents in the United States against the entire EU, it looks pretty awful. We're still seeing 20,000 plus cases a day, and when you have that background, it gets very difficult to do significant tracing.
Yeah. Max, don't be a stranger. Your work's been great. We haven't had you on enough. Max Nissan in the trenches of looking at this pandemic for Bloomberg News, really with leadership coverage. Lisa, I want to get to the market, and I want to go back to our interview with the governor of the Fed, Kevin Warsh, out at Stanford right now. We got rave reviews on that interview as he talked about a Fed out over its skis in terms of doing too much. When are we going to learn when the Fed does too much? I mean, is it going to be by the next meeting, or do we have to wait longer than that?
Well, the question is, what does it mean to do too much, right? The idea is they're propping up asset prices. You're seeing stocks get a lift. You're certainly seeing corporate bonds get a lift as they double down on those purchases. When does that trickle into the real economy? They did start their Main Street lending program. They opened it up for business on Monday. Still a lot of questions about the execution of that. And then there's the follow through from the federal government. But really my question, Tom, is who is ultimately responsible for the follow through in the real economy? The Fed only has so many tools, and how deep do those go in benefiting the underlying economy? I think that is a fierce debate, and one that a lot of people have to be having, especially as we look to Washington, D.C. and what happens with some of the policies there.
Well, on the IS curve in the real economy, and Mr. Warsh mentioned this a number of times, it is about that miracle, which is the microcosm, the little thoughts that we all have within any national experience. So you think the people of America will move this forward to a better economic growth and all the good outcomes from that, but we're a long way from that right now. Of course, you've got Chairman Powell coming up. That'll be very important to see at 10 o'clock, a redo there. And the Q&A always different between the Senate and the House. I need to do a data check here, which is really important. Futures up 11, Dow futures up 64. The VIX goes from 34 through 33. I got a 32.78 on the VIX, so that really gives you a sense of the continued lift. We're not back to where we were before the difficulties of last week, but we're getting there, really grinding up towards recent strength. I've been watching a 2-year yield, can't get through. There's a foot on the 2-year yield. Maybe it's John Farrow's foot. A 0.19 on the 2-year yield. We've got much more forward. I am thrilled that I will speak with Professor Eichengreen here on radio with Paul Sweeney in a moment. We are produced occasionally by Riley Debs. This is Bloomberg. Stay with us through the day. Good morning.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
We're not thinking about raising rates. Monetary policy is in a good place, and that's well understood in the markets.
Can you give Chairman Powell all the credit?
The signal was we're not going to let companies fail, so you may as well jump in and get involved.
The Fed shouldn't start pulling punches just because benefits are going to shareholders.
From New York City for our audience worldwide, good morning. Good morning. The countdown to the open starts right now with equity futures positive 30 minutes away from that opening bell. We begin with the big issue. The Federal Reserve emphasizing the long road ahead towards recovery.
We appear to be entering that second phase of the economy reopening.
Indicators do suggest a stabilization or even a modest rebound.
We probably bottomed out in sometime in early May.
In May, of course, there was a notable rebound in employment and decline in unemployment.
The surprise in the jobs number and strong retail sales is part of that narrative.
Call it the bounce back or the beginning of the recovery.
We're going to grow pretty strongly from here.
The economy will resume growth starting in the third quarter.
There are parts of the economy that will struggle to return to their old ways of activity.
Less to do with monetary and fiscal policy.
The course of the economy will depend on the course of the virus.
A lot more to do with how effectively we execute the healthcare policies.
It's going to take some time to rebuild confidence.
Heading towards day two on Capitol Hill with the Federal Reserve Chairman Jay Powell counting you down to that in front of the House this morning. A little bit later around lunchtime, Bloomberg's Michael McKee joins us now. Mike, the Federal Reserve emphasizing cautiously how much longer it's going to take to fully recover from this pandemic.
Yeah, John, it's kind of hard to get any news out of Powell yesterday because he didn't say anything we hadn't heard already. His remarks very consistent. The U.S. Don't bet against it, but don't bet on a quick recovery either. But there was one thing of interest for the markets, I think, and that is that the Fed now buying individual corporate bonds on the secondary market is not going to be increasing the amount it spends when it's doing that. They're just shifting from buying ETFs into individual names, and they're going to do that through an index. So no additional spending. Markets had anticipated the Fed would hoover up a lot of paper and may be disappointed by this. The feeling was that spreads had come down, as you can see there, with the announcement that they were getting into the business, and the Fed needed to follow through and do some buying, or those spreads would go back up again. But they're not going to apparently buy a whole lot. Powell, in his comments, and he's expected to repeat it today, said there's great uncertainty about the pace of the rebound. The economy seems to have bottomed out. You look at jobs and retail sales, but Powell said women and minorities still suffering the most. The poor, especially hurt by the downturn. It's going to be a long slog. He was asked about the need for additional fiscal spending and suggested that that's a probability. He wouldn't bite on what they should do, although he did suggest you want to look at states and cities which are going to have to lay off a lot of people given their budget holes. And then, of course, he promised, as he has, that there would be no rate increase until at least 2023, and that the Fed is not going to use negative rates. He brushed aside a question on yield curve control, saying they haven't decided that. One thing I did want to point out, though, John, you had Rich Clarida in your open there, the deputy. He last night noted disruptions caused by the virus putting downward pressure on prices, and he is worried about inflation expectations slipping, and that would make it harder for the Fed to keep us out of deflation. But as you can see from the chart, generic 5-year inflation break-evens, and then the University of Michigan Consumer Survey on inflation expectations just out last week, that doesn't show what Rich is worried about. So it's something to keep an eye on, but at the moment, it's not a particular problem. You can see the expectations are inflation is going to rise.
Mike McKee, thank you. Mike, counting us down to day 2 on Capitol Hill with the Federal Reserve Chairman. The Fed Chair asked about what they've been doing in this market, the impact they're having on financial markets. The Chairman keeps talking about market functioning, that they want to maintain market functionality. Take a listen to what he had to say about impairing market functioning. Take a listen to this.
I don't see us as wanting to run through the bond market like an elephant, doing things and snuffing out price signals and things like that. We want to be there if things turn bad in the economy, or if things go in a negative direction. We want to make sure that we're there.
We don't want to run through the bond market like an elephant, snuffing out price signals. Most people that come on this program would say the Federal Reserve has done exactly that. A price-insensitive buyer coming through the bond market and snuffing out price signals for pretty much everyone. Let's have that conversation right now. Let's bring in Priya Mitra of TD Securities. Priya, the Federal Reserve talked about market functioning. Back in March, quite clearly there was work to do, and quite clearly the Federal Reserve achieved its objectives. To sit here now and say that this is still about market functionality and that they don't want to run through the bond market like an elephant, isn't that exactly what they're doing now?
So, I think they are extremely large in terms of the bond market. So you make a fair point, but I will highlight market functioning can disappear within, days, within hours perhaps. So I think the Fed cannot take market functioning, the normalcy in market functioning. I think they can't take it for granted. We have a ton of Treasury supply that's slated to come, and this is before any talk of another fiscal package. So I think they need to be there. While, so I think, which is why they need to have the backstop, they need to have all the purchase programs, they need it to be flexible, because when we get more supply, the last thing the Fed wants is much higher interest rates. But I think they are in a bit of a dilemma, because if they buy too much, they can actually hurt market functioning. So I think that's what we have to see what they do in the corporate bond market. I don't think the Fed will end up buying a whole lot, because it looks like it's functioning. The Fed doesn't want to own too much of the market, because actually then they hurt liquidity. So it's going to be a flexible process. But I think they just want to keep rates low. Where they will be needed is when we start seeing the better data. But we've had unprecedented stimulus, and the world is reopening, the U.S. is reopening. You're going to get this better data. I think they're going to become the elephant in the room then to prevent rates from rising, because they seem to be a lot more worried about the structural damage that COVID might have caused to the economy. So they just don't want rates, at least Treasury rates, rising. So I think they'll become the elephant in the room later this year, because they really want to keep Treasury rates low.
Priya, quite clearly, the objective is to achieve the pre-COVID economy. That's an objective we would all share. We all want to see that happen. And to achieve that, the gateway that they want to go through is just to keep financial conditions really, really loose. Is the base case still just really tight spreads, regardless of the economic data, that spreads just grind ever tighter, Priya, in the face of whatever happens with this economy?
No, I think I'm a little cautious about spreads in general. I mean, certain companies, if you've got a good balance sheet and your business model still makes sense in the post-COVID world, I think absolutely those spreads can keep tightening. I think dispersion within spreads is going to have to be wider, because if there is structural damage done, I don't think the Fed can do a whole lot to offset that. If, some sectors are impacted, leisure, hospitality, it's very hard to see what the Fed can do, or low interest rates or financial conditions can do. I think all policymakers are trying to provide this bridge to the other side. But if the other side looks very different, then I think default risk needs to get repriced. Liquidity risk has repriced, and that's why all spreads, all risk assets have done well. That default risk, I'm still skeptical that the markets misprice that. And so while overall perhaps spreads are okay, I think you have to do a lot more credit work to make sure that you're owning the right product in the right sector, rather than just closing your eyes and buying. It's sort of not the QE trade. It's QE plus, I think, the longer run outlook, which we haven't had to worry about in the previous crisis.
Well, Priya, where does that leave long rates? Clearly, the data is surprised to the upside. Optimism, risk appetite has improved. The long end has drifted higher off the back of that. Is the steepener of the trade that you stick with?
For now, yes. I think what stops the steepener would be either, a big risk-off trade, and that's where I'm actually watching the resurgence in the virus cases. Now, if it's clear it's linked to reopening, if China, and I would watch China and Europe, they have a 2-3 month lead over the US. And if we are seeing a resurgence in cases there, I think that's going to put an end to the steepener right away, because ultimately the curve is a function of duration. So if rates start becoming the safe haven, treasuries become the safe haven asset, then it's really in the long end that you get any hedgeability, because that front end is sort of really flawed at these levels. So watch that. I think that would be one end to the steepener. The other one would be if the Fed starts to move its purchases out the curve. Right now, unlike QE, unlike Operation Twist, or at least unlike previous QEs, the Fed has been buying across the curve. If they start moving further out the curve, I think that puts the end to the steepener. I don't think that happens just yet. I mean, the 10-year at 70 basis points is still low. You start getting close to 1%, I think the Fed is going to have to become the elephant in the room and start buying a lot more treasuries in the long end.
Priya, I wanted to wrap up by talking about the tug of war right now that's playing out between the better data that we see in the United States and the outbreaks that we see in some states, some pockets of some states in the United States, and, of course, what we're seeing in Beijing, China. The equation several months ago was to see an outbreak and assume it would lead to lockdowns. That shifted. Now we're thinking about whether it impairs the reopening process or weighs on consumer and business confidence and hits the data. Is that the right way to be thinking about the way things are playing out at the moment?
Yes, and I think you throw in another thing in that equation, which is stimulus. I think that the rate stimulus is going to be much smaller. We need an aggregate demand stimulus. Are we getting a $3 trillion fiscal package that can provide sort of a longer or a broader bridge to the other side? Or are we just doing, things at the margin? So I would add that in. I think the market has been nervous about the virus uptick, but, it's sort of looking at all the unprecedented stimulus and might be extrapolating. I'm a little concerned that we may not get as much on the fiscal side, and I would say keeping rates low has limits to how much it can help. So if really we're looking at a pickup in cases globally, I think you have to become concerned about risk assets, and you should probably at least build liquidity, keep money in cash so that you're not a forced seller at that point.
Priya Misra of TD Securities. Priya, fantastic to catch up with you. As always, my best to you and yours. In this market right now, 19 minutes away from the opening bell. Equities fading just a little bit after 3 days of gains. The S&P 500 up around about 10 points, advancing 1/3 of 1%. Up next, the optimist, the more constructive Jay Pawlowski of TPW Investment Management. He joins us next right here on Bloomberg TV.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
At the moment, we have all the conditions in place for a decent economic recovery. The virus is, with some exceptions, mostly under control. We see lots of evidence in May data that the economic recovery has started to tick up, but critically, you have lots of economic policy support. The damage from the coronavirus recession is absolutely huge. It will be long-lasting.
That was Callum Pickering of Berenberg weighing in on the pandemic data that we've seen over the last month or so. And not just outbreaks in several states across the United States, but also in Beijing, China as well. I want to bring in Scarlett Fu, our markets editor, for more on this, joining us from the markets desk. Scarlett, this is the story of the moment, really. Upside surprises here in the United States on the economic data.
Yeah.
The pandemic data, though, just a little bit more fragile. And market participants trying to understand what on earth to do with it.
Yeah, the new virus numbers are downright concerning, John. Around the world, we've now topped 8 million cases of COVID-19. The U.S., as you know, is home to the most number of infections and deaths. New cases jumping by about 20,000. 6 states reporting record new cases. The hotspots, of course, California, Arizona, Florida, Texas. Brazil is number 2 in caseloads after the U.S. It reported a record 34,000 new infections. And Beijing, you mentioned, closing schools and canceling 1,200 flights as the capital city tries to contain this new outbreak. Only 137 at the moment, but it could multiply pretty quickly. India becoming the 8th nation to pass 10,000 deaths. In the Middle East, Iran warned it may need a new lockdown. Now, when you look at the market impact, there hasn't been much of one. U.S. futures are higher, as you noted. Asian stocks managing to sustain some of their positive momentum, even with geopolitical tensions between China and India and the two Koreas. And Europe holding up fairly well. When you look at the other asset classes, the 10-year yield, the dollar, little change. Oil not doing much as well, down 1%. But for oil, that's like nothing. Optimists will make the case that markets look ahead. And while there are pockets of outbreaks, governments are determined not to shut down their economy, not to have this massive blanket lockdown like they've done in the past. And of course, John, there is tons of government support from the Fed and from elsewhere, because even with Democrats and Republicans at each other's throats, the thinking is that both will continue to support the economic recovery in the lead up to the election. And of course, we can expect Jay Powell to reinforce this point when he addresses Congress, this time to the House Financial Services panel starting at noon today. John?
That's a couple of hours away. Scarlett Fu, thank you. Let's talk about what Scarlett was discussing, the tolerance of policymakers not to shut things down again, and where in the world you should be more cautious. We caught up with the Dallas Fed President, Robert Kaplan, on that issue. Take a listen to what he had to say.
I'm optimistic about China's recovery, but I would just note, for those who watch economies outside the U.S., for example, Europe, Germany, Germany's GDP growth will probably do worse this year than the U.S. Other European countries will do worse. Why is that? They're much more dependent on exports, and if China's weak, then European growth will be weaker.
Let's bring in the European optimist, shall we? Jay Pawlowski, TPW Investment Management co-founder and CIO. Jay, the more constructive view on Europe, you know that's what I turn to you for quite often. Give it to me now, Jay.
Well, I think Europe is picking up, right? Their economy is picking up. They did an exemplary job dealing with COVID-19. You've talked about China in the run-up to the show here. U.S. cases, obviously 20,000 a day. You don't see really any of that in Europe. So Europe is opening up. Europe is opening up within its region to travel, much more advanced than anywhere else in the world. And from a market perspective, John, I'll give you a couple of points. One, I think the tell was last week. The U.S. was down 6% on Thursday. On Friday, the Asian and European markets held up much better. That has not happened in a long time. Usually the U.S. sneezes, rest of the markets catch a cold. Second point, 4 of the top 10 ETF inflows last week were international equity ETFs and European ETFs. So the money is starting to move out of the U.S. and into the rest of the world, as we've talked about for some time. Third, I would make the point that the short base is still extensive in Europe, more so than in the U.S., where we've seen quite a bit of short covering the short positions that were built up in March and April. And finally, I think it's interesting to note that Europe also has an opportunity to catch up on the cyclical trade. Much of the action, John, we talked about this, the speed of the move, speed is the COVID signature. In Europe, it really has, the markets there really haven't caught up as much as, let's say, the U.S. in terms of the cyclical and value. Those segments of the market in the U.S., according to JP Morgan, have already kind of done what they're supposed to do. Not the case in Europe, not the case in Japan, which again makes sense. There's such a degree of caution and negativity towards the non-U.S. equity markets. I think that's in the early stages of changing, and that's where the upside opportunity really lies.
Jay, what I find unique about your call, and it's not come up in many conversations I've had, is that you believe the reopening process and the divergence between the success we might be having in some places and failures we're having with others will reinforce the outperformance of the rest of the world. Is that a fair characterization of things, Jay?
Perfect, John. You get an A+, buddy.
So walk me through why Europe is the place to be when it is a derivative of what's happened in China, as Robert Kaplan points out, and we're seeing the reopening process start to hit some bumpy roads in Beijing.
Well, I think that's true. But, John, we're talking about 100 cases in Beijing. The U.S. has 20,000 new cases a day. So, I mean, it's totally orders of magnitude different. And I think, look, as we've talked about, China and Asia is the lead here. They were first in, first out. And so we can see how they deal with lockdowns. You're seeing it in Berlin in Germany. There's an isolated outbreak. Quickly, attention is paid to it, testing, tracing, and the economies move on. Look, John, the other point that's important for Europe in terms of thinking about Europe versus the rest of the world is the stimulus coming out of Europe is unprecedented. We talk about it in the United States, but really in Europe, it's truly unprecedented to think about joint recovery funds, to think about green deals, to think about Germany spending 4 or 5% of GDP in stimulus. Up until 3 months ago, Germany was known as the black zero, right? Total balanced budget. So Europe is moving and responding quickly, and I think that's, and the main point is that, look, they're cheap markets, they're cyclical markets. We're in the beginning of a global economic recovery. That's when cyclicals tend to do best. And I believe markets and investors are significantly underweight a market that's starting to outperform. And that outperformance, John, is going to drive new demand in Europe and non-U.S. equities, particularly developed non-U.S.
Well, let's just have a follow-up question on what's happening in Beijing. The case rate is what they tell us the case rate is. But let's look at what they're actually doing. Shut down 1,200 flights today in Beijing, shut the schools again as well. Jay, even if the case rate is as low as they say it is, and let's hope it's even lower than that in the future, fact of the matter is, that city's starting to shut down again, isn't it?
Yes, and I think that's exactly the point, John. Look, China may have been correctly criticized for being slow off the mark when this COVID first developed. But I think since then, they've been very aggressive and more aggressive than many other countries. And I think this is a continuation of that. And look, markets have already told us, John, as long as it's a city shutdown or a regional or state shutdown, I think markets are going to be fine with that. And there's no political appetite. There's no economic appetite. We've made a decision, almost as a species, as humans, we've made a decision to live with this and to mitigate it rather than to stamp it out completely. I think that's most certainly the case in the U.S., which has basically said, we're playing for a vaccine and we're just going to accept 100,000 plus deaths in the United States. I do think the chaotic response of the U.S., coupled with the likely political uncertainty and kind of negative campaigning that we're going to see for the next 5 months, are two other reasons why the rest of the world looks attractive. Doesn't have the 20,000 cases a day, doesn't have the political uncertainty, does have cheap, undervalued, and underowned cyclical equity exposure available for purchase.
Some crude calculations as a human being, but of course for markets, markets do what markets do. Jay Pawlowski, great to catch up with you, sir, of TPW Investment Management. 7 minutes away from the opening bell, equity futures fading. We're up just 8 points on the S&P 500, positive 0.25%. Up next on this programme, we'll get you the morning calls. Some of the calls from the analyst community on Wall Street just around the corner. From New York, you're watching Bloomberg TV. Coming off 3 days of gains on the S&P 500, equity futures fading just a little bit, up just 7 points now, positive 0.2%. Here are your morning calls. RBC raising its Apple price target to $3.90. The analyst citing an improving macroeconomic backdrop and the company's share repurchase program. Next up, JP Morgan adding Constellation Brands to its focus list. The analyst expecting market share gains to accelerate as beer production begins normalising. We all need that. And finally, Goldman Sachs downgrading Valero to neutral, $68 price target. The analyst citing valuation, saying it's now reflecting the company's mid-cycle earnings power. Three of the calls from the street. Up next, the opening bell. We'll catch up with Dan Skelly of Morgan Stanley Investment Management. From New York this morning, good morning. This is Bloomberg.
they check into a hotel, they say, hey, I probably need to wear a mask. There's so many people. And so we should have that available, like a toothpaste and toothbrush.
When they walk in the front door of the hotel, the availability of hand sanitizer and disinfecting wipes. Again, we know that they're walking into an environment that we've cared for them in, but giving them the ability to kind of be involved in that, to kind of build their level of confidence.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True.
Equity futures fading going into the opening bell this Wednesday morning. We're up, we're positive, but well off session highs, up just 8 points on the S&P 500, positive 0.25%, around about 15 seconds away from the opening bell in New York City, with the bond market going nowhere. Treasury yields coming in around about a basis point or so. Your 10-year yield 0.74%. We come through just a little bit lower on a 30-year to 153, with Chairman Powell a couple of hours away. From New York, let's get to the market desk and get you some movers at the opening bell. Here is Scarlett Fu.
Thanks, John. Well, we're looking at a U.S. stock market that for now is focusing on the prospect of more stimulus that is trumping concerns over a second wave of the virus. I'm keeping my eye on a couple of decliners nonetheless. Oracle falling after missing its fourth quarter sales. Businesses pulled back on software purchases, especially those in the hospitality, retail, and travel industries. Oracle also forecasting flat sales for this quarter. DraftKings off by almost 4% after the fantasy sports and betting site says it's getting ready to offer up more shares, 33 million shares, including 19 million held by insiders. And this comes as live sports gets ready to restart. UK soccer, or football, sorry, John, starts today. And PG&E is higher by 1%, set to emerge from bankruptcy 19 months after Campfire. It'll sell $8.9 billion in investment-grade bonds as part of its funding after the judge approved its $59 billion plan yesterday. Now, speaking of investment-grade bonds, we know that LQD, the biggest ETF tracking investment-grade corporate bonds, has been on a tear since the Fed said it would buy corporate bonds, expanding its balance sheet. There you see the demand going up as the balance sheet expands. John?
Scarlett Fu, thank you. Soccer, football, at least you understand the difference. I've spent 10 years with Tom Keene trying to explain to him the difference, and he still does not understand. Scarlett Fu from the market desk. 1 minute and 20 seconds into this session, equities advancing around about 1/3 of 1% on the S&P 500. A little bit of a defensive tilt in the immediate aftermath of the open, though things improve a little bit with materials leading the gains, energy lagging. Energy had a massive session in yesterday's session on Tuesday. This Wednesday, Apple already intraday record high. We'll talk about big tech in just a moment. Let's turn around and have a look at the bigger picture from Morgan Stanley, who say the following. We maintain our positive views for US equity markets because it's early in a new economic cycle and bull market. Last week's correction was overdue and likely has another 5 to 7% downside. It's healthy, and we're buyers into the weakness with a small mid-cap and cyclical tilt, raising our S&P 500 target to 3350. That was from the team led by Mike Wilson. We can catch up with a colleague of his, Dan Skelly, Morgan Stanley Wealth Management Head of Market Research and Strategy. Dan, you're maintaining that cyclical tilt, and I caught up with Mike Wilson about this a little bit earlier this morning. Your big push, your stance for the last several months in the face of a lot of people that have pushed back, is the belief that the recession playbook still applies, and this time is no different coming out of contractions that we've seen before. Is that still the case, Dan?
Yes, it is, Jonathan, and good morning. Thanks for having me on this morning. So we want to highlight that a lot of folks are looking at the reactions of the market low of March 23, and they're looking at things in very short time frames, weeks, days. And we would highlight it's really important to take a step back, Jonathan. If you zoom out, you would observe that going into this crisis, into this recession, there were a lot of normal late cycle characteristics that were reflective of how markets were trading. You actually saw large cap quality and growth doing quite well. You saw defensives doing well. You saw cyclicals doing poorly. And you saw the yield curve invert as well. And all these things were going on for a year and a half to 2 years prior to the crisis hitting. So while no one knew what the epicenter of the crisis would be this time, right? No one ever really does know what the exact source of the crisis is. We saw these trends trading like this for a long period of time. And we would say just because you've seen some cyclical rally and some power off the March 23 lows, it certainly doesn't mean that it's over now. In fact, we think it could continue over the next 12 months.
Dan, you've said embrace cyclicality. The whole team at Morgan Stanley has, and it's really paid off in the last month, the last couple of months. Can I push back on one thing? Can I just lobby the team at Morgan Stanley just for one thing? You guys as a team expect the economy to fully recover by Q4 2021. Dan, why are you calling that a V-shaped recovery when quite clearly it probably isn't?
Yes, I think there was a lot of debate going back 2 to 3 months ago, Jonathan, as to what the recovery would look like. We heard the alphabet soup from every economist on the street trying to predict V or U. And I think that the debate as of now is frankly over. The V has started to occur early on. We've seen retail sales surprise. We've seen positive consumer activity as we've started to reopen. You know, there's a bit of a pent-up demand that I think many weren't actually predicting as strongly as Morgan Stanley was three months ago. So to your point, Jonathan, the question is, where do we go from here? Is there a risk that this initial V starts to taper off and becomes more of a square root sign or more of a check mark? And what I would say to that is we continue to expect continued reopening, a second wave, no doubt, in likely late summer or fall, but one that's more modest in nature in terms of its impact. We continue to see a strong consumer powering sales going into next year. And we think, frankly, you know, you've heard the policy commitment from both the Fed being on hold and not causing financial conditions to be an impediment. And secondly, we do expect, and this is really key to your question, Jonathan, we do expect additional rounds of fiscal stimulus.
Well, Dan, I don't want to get bogged down in semantics, so forgive me. And from my own humble perspective, I hope you don't think I'm being rude to you. It's just when I look at your forecast, they don't resemble a V. They do resemble just a checkmark recovery, which I admit you are much more constructive than most. But to expect a V, you're looking for a full recovery by the end of Q4 2020. That would be right, wouldn't it, Dan?
Yes, so that would be obviously a much more accelerated time frame. I think you can certainly debate the aesthetics of the curve and what it looks like. I think the key is, contrary to a lot on the street and the consensus who were predicting much more dire outcomes, as you kindly alluded to, you know, we've been saying for some time that we think this is a very deep but very short recession. And in fact, we're predicting, as you just mentioned, we're predicting GDP in the developed world to recover by Q4 of 21, which will be twice as fast as the recovery coming out of the 08 crisis. And that's, I think, where we're chiefly different, Jonathan, is that many were saying that this is like 08 or worse, and we have not been.
So let's talk about the markets, and we'll get away from the semantics just for a moment. Let's talk about the markets. If I had an airline and I could run 100 flights a day, and we went from 5 to 10, from 10 to 15, up to 20, 25, through the summer, people would be really impressed by the rate of change. Other people would be less impressed by the capacity utilization. Dan, are you hopeful that the latter doesn't become a story? Do you just think the market will focus on the former almost exclusively? I'm just trying to understand that broader tension at the moment, because certainly we've got some great rate of change on the cards for the month we've seen and the months ahead. And you guys have embraced the cyclicality, and you've been right to do so. But I'm just trying to understand, for some companies out there, they will be operating at 80, 85, maybe 90% of capacity, which on paper sounds great, but when it was 100 a year ago, I just wonder how some of these companies would actually make money.
Yeah, it's an excellent point, Jonathan. And look, I would largely agree that, you know, the stocks may act at certain points disconnected from the real economics and from the real fundamentals. And the reason for which is the stocks at any point in time might be reacting to macro factors. They might be reacting to stimulus. They might be reacting to progress around a vaccine or progress that the health crisis is reaching its apex and recovery. And so I would just say I concur that there are fundamental earnings issues in some of these areas, no doubt. They're not going to come back to 100% capacity right away. And therefore, you need to be selective in what you do. We've been advocating an active approach to picking value names, picking cyclicals. But the last thing I would add to this, Jonathan, is another area of research that our team at Morgan Stanley has produced. In fact, this morning from the TMT, Telecom, Media, and Technology teams and equity research, talking about the pull forward of all these digital transformation trends. And so that's not to be lost. Amid our conviction and our bias towards value and cyclicals over the next year, as we see this economy recover, we're still highlighting that you don't want to abandon some of the growth areas of the market because, really to your point, some of this crisis has pulled forward the digital transformation, and the earnings power of some of those tech platforms are frankly going to do quite well.
Dan, I wanted to fit in one more if we can. As you look at how things are playing out in Beijing, I just wonder how the equity team are processing the outbreaks, just the hot spots. Not a huge story right now, but you can see it building. I'm just wondering how you think your clients should manage their exposure to cyclical areas of this market in the face of that.
So the reality is that we're going to have flare-ups as economies reopen around the world. I think what's different this time, and Matt Harrison, who's our lead biotech analyst, who's led a tremendous exhaustive effort looking at these trends from the COVID standpoint, I think the reality is we're going to be in some ways better equipped to handle some of these flare-ups, given the fact that Beijing looked at this and immediately confirmed some of these issues. They've locked things down fairly quickly. So I would say globally, we're in a better place given our ability to test and confirm cases and isolate cases. We're in a better place. Obviously, we've heard a string of positive updates on antiviral therapies. We've heard some leading pipeline around vaccines. Now, we would caveat that vaccines are going to have, obviously, a deliberate approach, and we're not going to see mass distribution right away. So we want to caveat around that. But I would just say we definitely think the second wave is more modest than the first, and that certainly helps inform some of our positive views around the economy.
Dan Skelly, you've been constructive on the recovery and you've been constructive on the cyclical areas of this market, and it's paid off big time in the last couple of months. It's fantastic to hear from you once again, mate. Dan Skelly there of Morgan Stanley Wealth Management. In this market right now, 10 minutes into the session, we fade just a little bit. We are unchanged on the S&P 500, positive on the NASDAQ. Let's get you some movers. Let's return to the market desk. Here is Abigail Doolittle.
John, in a moment, we'll be taking a look at a group of stocks that is dragging on the S&P 500, helping to explain why it is about flat right now. But first, PepsiCo, those shares are popping ever so slightly. This is one of the bigger headline stories in an individual company this morning. They are retiring their Aunt Jemima name for breakfast products against the backdrop of nationwide protests against systematic racism. This is a major brand shift. It dates back more than 130 years. The company's Quaker Oats unit will remove the image of a black woman from those products and marketing starting in the fourth quarter. A name change will be announced at a later date. And in addition, the company is going to be spending $400 million over 5 years for race equality measures. Qualcomm is also popping higher. They are going to be introducing their Snapdragon chips for 5G in some phones by the second half of this year, and 5G is seen as a way to boost smartphone sales hurt by the pandemic. Kroger popping also just a little bit at this point, actually, ahead of their report tomorrow. Comp sales are expected to soar as folks have been stocking their pantries amid the lockdown. And then the group of stocks really dragging on the S&P 500 in particular, John, that I was mentioning, the cruise lines. Norwegian Cruise Lines has extended their cruise suspension to the end of September. This dashes hopes for an industry rebound by the end of August. And if you can believe it, up to 42,000 cruise line workers still stuck at sea. This stock in particular, Norwegian in particular, down more than 65% this year. John, there is a big bearish short interest on that stock of 17%. So an unfortunate situation overall, but those bears have really gotten that story right, for better or worse, John.
Abigail, thank you. Some unbelievable stats from Abigail Doolittle there. 12 minutes into the session, equities advanced just 0.1% on the S&P 500. The NASDAQ is where your outperformance is. Up next on this program, PIMCO's David Hammer on municipal bonds and state finances. That's next. This is Bloomberg TV.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Fifteen minutes into the session, equities advance 0.25% on the S&P. Your Nasdaq is where your outperformance is, up 0.7% as we count you down to day two on Capitol Hill with Chairman Jay Powell of the Federal Reserve. This Federal Reserve has done a heck of a lot for this market. Take a listen to what Chair Jay Powell had to say about the Federal Reserve's municipal facility.
On the municipal facility, we've repeatedly made adjustments. We can't make grants. That's one thing we can't do. We can only lend. The law is extremely clear on that. It's you who can make grants. It's Congress that can do that, as you did with the PPP program.
Will there be loans or will there be grants? And what do these states and municipalities actually need? Our Moody's expert, Taylor Riggs, joining us now from the markets desk. Taylor, an important slice of the fixed income market. Just how much help do some of these states still need?
Well, come and take a look at this chart here, John, because it's in part because of that municipal liquidity facility program that two-year yields came down from 3% in the peak of the funding issues, in the peak of the panic over how some of these state and local governments were going to navigate this crisis, now down to just 24 basis points. That's in part thanks to the Fed coming in and stepping in with some of the illiquidity issues that were going on inside the market. If you flip up the board, we always talk about munis relative to treasuries. Anything above 100% makes them look attractive on a yield basis, even before you take into account some of the tax benefits that you get from owning munis relative to treasuries. So you are getting a lot of some non-traditional buyers coming in, given that ratio still 112%. Finally, let's flip up the chart and take a look at the terminal, because another big issue that we're talking about when it comes to munis is all about that $1 trillion infrastructure plan. Would that help boost some of the local economies for these state and local governments? Well, if you take a look there at the Muni Bond Infrastructure Index going back since Trump was elected, you can see basic roads, bridges, tunnels, potholes, all outperforming some of the corporate bond index. Typically, you have clear revenue streams. Muni buyers attach a premium to that, given those streams. John.
Taylor Riggs, thank you very much. Fantastic work, as always. Here's one take. It comes from BlackRock, saying the following: austerity measures at the state level would exacerbate the recession and delay the economic recovery. The desire to avoid such a scenario might compel Congress to pass another round of fiscal stimulus in the months ahead. On the help, the assistance that could come from DC, I'm pleased to say that joining us now is David Hammer of PIMCO. David, fantastic to catch up with you, sir. Let's explore that. The degree to which the fate of this asset class will be determined by what Washington, DC does next. The extent to which that is true.
Hi, John. Thanks for having me. Well, we're certainly looking to D.C. and Phase 4 fiscal stimulus to determine just how much support state and local governments will receive. This recession is both the sharpest and the shortest, and just to put that in context, from 2009 through 2011, states accumulated budget deficits in aggregate of about $500 billion. Given the depth and suddenness of this economic shock, states may be facing a similar deficit number, but over a one-year time period. Now, the beneficial component for states is their initial conditions are stronger today than they were a decade ago. Rainy day funds and reserves are about 1.6 times what they were in 2007 as a percentage of expenditures. The federal government has already lent some support through the first CARES Act. What we're looking for in Phase 4 stimulus is ultimately both the size and the timing will help determine just how much states need to cut budgets and raise taxes versus being able to continue to spend at levels that were close to pre-crisis.
David, one thing you've pointed out, and I can sense how much more constructive you are than many, is how dependent local governments are on property taxes. So you've talked about the size of this plan from DC. How quickly would they need either help from Washington, or how quickly would they need to engineer and execute austerity, given in mind just how dependent they are on things like property taxes?
Yes, states and locals are very different. For states, I think speed matters. The fiscal year 2021 budget season is well underway. In most states, that will conclude sometime this summer, so speed is important. Looking at local governmental credit, it is a different story. As you know, many local governments are funded primarily by property taxes. There is a lag effect between an economic shock and property values moving up or down. But I will say that the locals also have less flexibility. So if states don't receive the funding that is required to continue spending, and they need to cut budgets and solve for deficits, locals will probably feel a component of that. As states cut cash that would otherwise be downstream to locals, locals have less taxing flexibility than states do. And that's why we've seen an increase in local defaults following the great financial crisis. While we think default rates remain in aggregate low, local credit is an area that we're quite concerned about and a bit more cautious due to that downstreaming of cash from states.
David, do you think the market right now is doing a good job between discriminating between the weakness you've highlighted and the strengths that you've highlighted as well?
If you look at, again, back to the effect of the financial crisis, there were many more downgrades than upgrades in 2009, 10, 11, even to 2012. That's recently reversed in the last several years. We've seen more upgrades and downgrades. Rating agencies tend to be a bit backward-looking. They work with data that's already come in. So I do think that looking ahead, there is a potential for much greater credit differentiation than what's been in the market for the last several years. So we see a lot of bonds today where the credit spreads look much tighter than we would otherwise expect, given our own internal rating, or in some cases, wider. There are areas where muni bonds have been sold maybe for the wrong reasons, such as not-for-profit healthcare systems in New York that actually are quite resilient and defensive, but there may be an additional risk premium due to fear that it's a hospital in an area that's had a high exposure, high concentration of COVID cases.
David, before we let you go, I did want to fit in why so few people, so few municipalities, states, local governments have actually tapped the facilities at the Federal Reserve. Do you think it's the terms, or do you think it's the stigma attached to approaching the Fed? Which one do you think it is right now?
Yeah, monetary policy and the impact on markets is new for the muni space. The Fed is taking a much larger role than they have historically. The municipal liquidity facility is the largest facility, offering up to $500 billion to states, cities, counties, and as of a few weeks ago, 2 revenue bond entities per state. So this includes things like the MTA here in New York. What we've learned from this facility by the pricing is that some issuers will benefit from it, but most probably won't initially. The pricing terms are on average about 100 to 150 basis points, so 1 to 1.5% above public market rates today. So most A-rated, AA-rated muni issuers, they're much more likely to go to public markets to borrow. For some of the lower-rated investment-grade credits, such as the state of Illinois, the Port Authority, state of New Jersey, the MTA, some of these have made announcements that they do intend to tap the municipal liquidity facility because the cost of capital is lower. Now, as an investor, we rather like this. So the state of Illinois is an example. When the state announced that they would go to the MLF due to a lower cost of capital, that was actually quite positive for their bond spreads. The state of Illinois was borrowing money between 5 and 5.5% before the rates on the MLF were announced. Those yields in public markets have come down today to about 3.75%. So this is good as an investor. It means the state has access to a lower cost of capital. That's positive for their budget.
Yep.
And it means less supply of new bonds to compete with. So there's a bit of a premium to bonds that are already outstanding. So we don't think there's a stigma. We think if it's beneficial for a state, city, or revenue bond participant to achieve lower cost of capital, it's actually a good thing for bondholders.
David, fantastic to catch up with you. David Hammer of PIMCO, as we count you down to day 2 on Capitol Hill with Fed Chair Jay Powell.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
From New York City, that does it for us. Chairman Jay Powell just around the corner from New York. This was the countdown to the open. This is Bloomberg TV.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things, they're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things in life happens. Yeah, I'm here by myself.
So, ¿dónde vive acá? En la parte de
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
The lives you touch and people that you can affect, I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade and they helped us finalize the venue, and it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a Juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on t-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for Mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, US Navy, and other branches of the US government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral Murder Video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan War Logs, 390,000 documents known as the Iraq War Logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats could face real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the US government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 US election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
When people think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for
Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
And from that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the US that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believes that she had sent, this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
US elections. Yes.
the US has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world, yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, capital say, 24 people went for the job. 23 people accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word beer. I don't know why, because it's easier to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强他的硬件，强就强他的系统基础，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange, but it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker, and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different?
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Valleywag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out, Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the US, China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The US was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the US commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and US states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. Origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch, some people come with an Adobe Illustrator file, and we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature. And it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I've learned so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it. And we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when you see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, it is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.